I think numbers don't lie, and I think Navin has laid out, I think, a very thoughtful case about the number of companies funded tends to be on the order of 1,000 a year. The number of companies that are that receive capital, about 3,000 a year, and the number of companies that are in venture capitalist portfolio. And we hear various numbers about that, but sort of 4,000 to 6,000 companies is probably the number that remain. Not all of those companies can or should or will receive additional capital. Having said that, I think this last decade has been about a lot of attention has been given to portfolios of all the venture firms, certainly those represented in this room and elsewhere, to culling the portfolio and to making sure that those companies that remain in the portfolio have strong reason to exist and have the ability to attract capital or to get to cash flow positive basis. So I'm reasonably optimistic that the percentage fallout will be low in the immediate future. The real issue is always cost of capital. And the cost of capital when the public markets are shut to our companies is relatively high, and the cost of capital, frankly, is likely to go higher for venture firms as the availability of capital coming into the venture sector, I'm sure we're going to talk about this, may be increasingly constrained. Last year, we invested approximately $20 billion as an industry into young companies. We're at a rate of investing at $20 billion. Dixon has pointed out that the, quote, venture overhang is at historically low levels. And that suggests that there's not the availability of capital to continue investing at this rate, and therefore some refocusing and either sell off of companies or shutdown of companies there's some of that left to do if cost of capital remains so high and the availability is low.
Given the closing of the window over the last 18 months, some opening now, but is there a need to restore the confidence of the institutional investor and indeed of the venture-backed CEO in the IPO process?
Well, I think over the last year we've seen M&A interest really pick up quite a bit, and certainly IPOs give us a whole nother dimension because now we have an alternative where we can go back to an alternative exit path, and clearly the multiples can be fantastic. And we had a very good experience with a company called Rackspace, and I think what's I think very interesting in the economy today, because a lot of public companies now are so heavily driven by analysts and the public markets that they really don't have the opportunity today to do heavy R&D anymore. I think there used to be a time where IBM and Xerox, a whole bunch of other companies put a lot of money into R&D. They've really curtailed the amount of R&D. I don't see a lot of big innovation right now from large companies. We as a venture capital industry have the opportunity and continue to have the opportunity to invest in a lot of things. And quite frankly, I think we have more advantage now because now we're not competing with the public companies anymore. So I think the M&A market will continue to be rich and robust because public companies can't create the heavy R&D investments anymore. I mean, you see there are some exceptions, Cisco, Microsoft, Google, but for the most part, big, hairy investments that take many years to develop, but that's something that we put on our backs and with our limited partners. And so I think we're building more advantages into our ecosystem. Now, certainly IPOs are going to be helpful, and we're seeing an appetite for IPOs. I think this whole thing in Europe has been a little bit of a downer, and I'm not quite sure the ramifications, but the last year was feeling pretty good.
Last year, we invested in 24 new companies. We invested $250 million in those 24 companies, and we had follow-on investments of $491 million. We had 17 exits by M&A activities last year. We had one M&A last year. One IPO last year. We have had one so far. We have 3 in registration. One of them is on the road right now, Motricity. I think it's going to go pretty well. Financial Engines was a bellwether in the first quarter. Gary and I are involved as directors on Force 10 Networks, which I think is going to do pretty well. And then we have another company called Vixis, which is in registration right now. So we have these 3 companies in registration. I think the 40 to 50 that Dixon used is a pretty good number. You get to the time it's going out of the hourglass where you can actually put in registration, get them through the pipeline, so it might go over to early next year. But I think, I agree with what Matt said. I think our competition coming from the accounting profession has done its best to curtail R&D. And so I think that the consequence is that we do have less competition from corporate R&D, and it turns out to be a very symbiotic kind of a relationship. It can work. So I think exits are, hard to come by, but they're well worth it. But it really does shine a light on what's the best way to tax these entities at the time.
So, is venture capital plentiful now, or is it scarce now? I mean, is there an overhang? And I'm going to ask everyone to comment on that, but I'll start with Gary.
So if there's overhang, we don't see it. I think overhang takes the form of high competitive pressure for deals and prices being paid that are too high on those deals. And my observation is that the venture market is bimodal today, that there are a small number of deals which clearly have momentum, that clearly have leadership in their marketplace and serve a large served available market with strong management and solid investors. And those companies have no trouble raising capital, and in fact, there is competition for not just to place capital, but to accelerate your time frame to come to a decision and to get a term sheet in front of the company. So I would ask my fellow panelists, but we see that class of company, and then the other class of company that we see are companies where they march up and down Sand Hill Road, and they present for months on end, and there's interest. There's some substance to the company. There's some reason for hope and optimism, but there are no term sheets. And this can go on for months and months until finally someone breaks from the herd, as it were, and issues a term sheet or not. But most of these companies find it very difficult to raise capital, and in an era of capital overhang, that would not be true.
Sean?
I think Gary articulated very clearly. It feels very scarce right now, and that's what we're seeing. I mean, just existing portfolio, we've got 75, 80 companies, and even deals we're looking at, it's not 5 term sheets, it's usually a couple.
I think venture capital has changed a lot, right? Most of the firms are becoming multi-stage, and when venture capital numbers get reported of 20 billion being invested last year, 70% came to IT. Say it's 14, 15 billion, but early stage is only attracting 17% of the capital. So it's 2.5 to 3 billion. And then if you look at the clean tech deals, if those deals get done, they probably are taking 40 to 50%. So what is left for what was like traditional venture capital per year? Early stage, it's 1.25 to 1.5 billion dollars, right? And I think if I look at that with 700 companies attracting that, I think innovation is happening, as we heard. I said that before. I think the best deals are attracting 5 to 10 term sheets, especially in consumer if they have momentum. The prices are going up, but there's a reason, because we believe those can have unbounded exits, right? Can they be worth 5 billion, 10 billion, 20 billion? It seems like on paper, that's why people are willing to pay 70 to 80 to 100 million. And I think what we are seeing is the traditional stuff, which is enterprise, semiconductors, telecom equipment, which was the bread and butter in a way before the consumer internet happened of Silicon Valley, those are the deals, right, are getting ignored. And as long-term VCs, those are the ones to do, because you can have growth in consumer and in media, but at some point, the infrastructure is going to break, right? Look at the success of iPhone and iPad. Wireless networks are breaking. Are the big companies going to solve those problems? No, right? We exited out of Vicorus. That was acquired by Tel Labs in the 4G WiMAX LTE space. There's much more to come. So I would say some sectors, are being chased, multiple term sheets. But if I look at in the balance, there are many sectors getting ignored, and their venture capital is scarce.
Yeah, I think you scratch the surface, below the surface, and there is not a pretty picture among the venture capital firms. I'm not talking about companies, the VC firms. There's so many firms that are just hoarding their last bit of liquidity, and it's not a good picture to see. And I think it reflects on the syndicates that we have. I mean, you can't afford to have a firm that doesn't have the ability to sustain itself. And it's a very desperate situation in many cases.
Matt?
Yeah, I agree. I think there is a capital shortage. I'm a third-generation general partner at Norwest, and we've always believed in syndication through other downturns. So it's very important to us because the Series B and Series C type of financing can be a no man's land. So we want to make sure that we have the muscle with our co-investors to carry a company through. And it goes back to what Dick said in his presentation. I think there's a class of venture firms that are just, people are afraid to jump off the diving board. And as a result, if you have a fresh fund, I think it does give you some advantage. And we're also not walking away from capital-intensive investing. We think that everybody's trying to go into these very, capital-efficient markets, and we're doing that as well. But we're also going after some very big capital-intensive investing because, quite frankly, we're not seeing competition for those investments. And historically, the venture industry has made very good returns over investments that are hard to do, and usually there's a correlation with difficulty and capital. Now, we're becoming very stage agnostic, and we do think there's a capital shortage out there.
Agree.
Sandy?
Sure, all good comments, and I really agree. I think we're in a healthy balance right now. I mean, there are situations, thinking now about the companies getting funding, there's a lot of companies that can't get funding. That's not a bad thing. The capital markets are supposed to be a governor on ideas. And in situations, and Gary alluded to this, where all the ideas can be funded, that's not a healthy situation. So I see it in a pretty good balance today, and I think that's good for the entrepreneur at the end of the day, and it's good for the venture firm. It is also a kind of a bit of a bimodal distribution, as we've talked about as well, with the haves and have-nots in terms of where the interest in the company lies.
Craig, can I volunteer one comment?
Please.
I think that Matt makes a very interesting point. And a new variable in the equation is with the consolidation of the venture capital industry and some number of firms not receiving additional capital and some number of other firms being out of the market while they're waiting for their portfolios to mature such that they can receive additional capital. There's a new dynamic, and that is that your syndicate partners are not always there to support the financings, and that creates yet another risk, a financing risk for these companies that we on this panel and through the room and through the industry are facing, which is different. It's one more risk in the equation, but it's a very real, and it's a risk you cannot afford to ignore.